Let me say something that might go against what you're hearing right now. Stop reacting. And I don't mean ignore what's going on. I mean, stop letting every headline, every article, every opinion dictate what you feel like you need to do next. Because this week alone, I had a client send me 3 different articles about the market. One said we're heading into a recession, one said the market's about to rally, and one said to move to cash immediately. 3 completely different directions, all sounding convincing. And if you read enough of that content, eventually one of those people is going to be right. But that's not a strategy. That's a reaction. And that's where people get into trouble. Because what starts happening is you begin making decisions based on how you feel in the moment. And the market's really good at making you feel something. When it's going up, you feel like you should be doing more. When it's going down, you feel like you should be doing something different. And over time, that consistent reacting leads to poor timing, buying when things feel good, selling when things feel bad. And that is the exact opposite of what actually works. So let me give a simple example. If someone had a solid plan in place and they just stayed disciplined through the last few years, the ups, the downs, the headlines, they ended up in a very different position than someone who tried to adjust every step of the way. Not because they were smarter, but because they were consistent. And consistency in investing is far more powerful than being right in the short term. And at HD Money, our approach is a little different here. We don't build plans that need consistent adjustment based on what's happening in the news. We build plans that are designed to handle uncertainty. And that starts with the structure. First is income. Make sure that your lifestyle is supported no matter what the market does. Because when your income is stable, you don't feel pressure to react. Second, tax strategy. Because what you keep matters more than what you make. And how you take money out of your accounts matters just as much as how you invest it. And the third is risk. Making sure you're not taking on more than you actually need to. Because too much risk creates emotional decision making. And then and only then do we focus on growth. That order matters because when those pieces are in place, you gain something that most people don't have, and that's clarity. And clarity leads to confidence. So when the market moves or headlines change, you don't feel like you need to chase it or run from it. You just stay aligned with your plan so that if you've been watching the news and scrolling through articles and feeling like you should be doing something right now, take a step back because reacting isn't a strategy. Having a plan is. And if you're not sure whether your current plan is built that way, or if you just want to revisit it and make sure that everything is aligned, that's exactly what we're here for. At the end of the day, your money should support your life, not control it. We'll see you next time.